Good afternoon and welcome to our January USDA webinars. We take a look at this morning's crop report, or for those of you in the east of the noon hour crop report, USDA's January reports are known for their surprises, and they certainly did not disappoint with us with this report at all. This report is known for its surprises simply because of the sheer volume of data that is contained within it. And when you have that much volume of data, estimates coming from USDA compared to the trade estimates, there's going to be some surprises in there. The first to respond to those surprises, of course, are the computers, the algorithmic traders that do their thing, and then the humans come in a little bit later as they're able to read the headlines coming across. Got a lot of volatility right off the bat as expected. Then we kind of settled into a pattern with soybeans pushing higher, leading the way higher, followed by wheat and corn firm as well, but not quite the extent of strength. We'll go into the numbers here today and talk about why that was. So first of all, we've got to go back to the background. What drives the markets? Well, price is still a function of supply and demand that is modified by the flow of money. So what's the flow of money doing? We came into this report with a more positive bent because of developments over the past couple of days, and that was certainly positive for the grain and oilseed markets. Had it been more bearish in nature in the way of the surprises, it reduced the size of any losses we would have had. On the other hand, those that were gaining, it probably amplified the gains, most notably in the soybeans. As we look at the dollar movement, of course, this is a weekly chart going back to 2009. We see from January of 2015, we were pretty much in a sideways trading pattern until we got to really this last fall, and then especially the elections where we propelled higher, hit a 14-year high in December, and we started to pull back. That correction lower looked like it was about to end until yesterday. And that's when we saw renewed strength coming into the currency market, people buying the dollar on a global basis ahead of President-elect Trump's press conference. They were buying it because they expected him to speak more about his strategy for bringing about tax and regulatory reform that they anticipate will stimulate economic growth in the United States in the coming couple of years and push the Fed toward more monetary tightening with higher interest rates. He said very little about that. Instead, the bulk of the press conference was about alleged security leaks and about diversifying and separating himself from his business interests to avoid conflicts of interest. There wasn't anything necessarily there detrimental to the overall expectations of tax and regulatory reform. It just didn't provide fresh fodder for the bulls. In a market that had been rallying strongly, needs fresh fodder for the bulls on a daily basis. It wasn't there, so it was an opportunity to correct lower, both in the currency market and in stocks, and that allowed more money to go to the commodity sector at large. When the dollar is rallying as it has been, that means weaker currencies that we compete with on a global basis, not just that compete with us, but also who buy from us. And this is a chart showing since January 15th, the decline as a percent of value based on January 1, 2015 values. And you can see that some currencies have dropped significantly, specifically the Egyptian pound, that's down about 150, 160% from where it was in January of 2 years ago, largely because they've now allowed that currency to float on the market, but also the Argentine peso, the Brazilian real, many other currencies. And that does affect negatively our ability to compete on a global market. First of all, let's look here at spot corn prices against the Brazilian real. You see on the left the chart showing the Chicago Board of Trade futures on the dark line there, the dark blue line, the light blue line being the Brazilian real, and how much higher in price, relatively speaking, their currency are, giving them an incentive to expand production at a time when our market's trying to discourage production. You see it versus the Argentine peso on the right. Here's the same thing for soybeans, and you can see how currency exchange rates make a big difference, both in allowing them to compete on the global market, but also in providing an incentive, since their soybeans are sold in dollars and then converted to local currency. it provides incentive for continuing to expand acreage and to plant more. As we look overall, you've seen this chart before if you've been with us on previous webinars, but we saw a massive expansion of acreage back in the 70s. Much of that growth because of higher prices in the bull market that we saw then, the commodity boom, much of that growth and expansion was in the United States, Canada, and Europe. And then we went through a period of time with relatively stable prices, and acreage in the world stabilized as well. But then came the commodity boom of the 2000s, and now we're expanding acreage once again. We have big surpluses here in the United States, so that means that prices have been going down to multi-year lows, trying to discourage production. But as I indicated, because of those currency exchange rate differences, it's still encouraging expansion overseas. Now, when we look at the Crb Index, that's one of the many commodity indices that are out there. It is, with the strength of the dollar, you'd expect it to be going lower, but of late it's been going sideways because crude oil has been holding it up. This particular commodity index is a little better than 40% in the energy sector. It's more heavily weighted toward the energies. Other commodity indices that are more equally weighted in their basket of commodities have more of a negative bias but are still being held up by crude oil. The continuous commodity index is one of the more popular ones that's in that type of, that has more equal weighting. But it gapped higher today as well because of the money. This doesn't show it, this is a weekly chart, but we gapped higher on the daily charts because of the money flow coming in as the dollar broke and crude oil was moving higher. On this chart, we put that Crb index again is the orange line. The blue shaded area is net fund ownership of corn, soybeans, Chicago, and Kansas City wheat. See up in the upper right-hand corner there, very strong correlation. Anything above 0.7 is considered a strong correlation. Here again, tying it together with the dollar is very important to grain and oilseed prices. So now let's get into the numbers. As I said, today the dollar was breaking, and so money was flowing into the broader commodity indices. We see here in the upper left that corn yield and the soybean yield dropped modestly from where they were back in November when USDA last made adjustments. USDA had been very close to our survey-based estimate, and from a percentage standpoint, the error is still very small and very reasonable and acceptable, but it did end up, particularly with some modest reductions in acreage for both corn and soybeans as well, in a reduction in production. The size of the crop dropping to 15.148 billion bushels we see there on the upper right for corn, and that was down from 15.226 billion in November. Soybeans at 4.307 billion, that was down, 75 million bushels from where we were in November. The next big report we take a look at is the quarterly stocks. This is how many stocks, how many bushels, both on-farm and off-farm, were present in the USDA survey on December 1. Wheat, 2.073 billion bushels. That was about 17 million bushels more than what the trade expected, meaning that we're not feeding as much wheat as what USDA had anticipated, and they ended up lowering their wheat feeding estimate down to 225 million bushels, which is where I've been now for some months. I just simply did not see the wheat feeding that USDA was projecting. It wasn't happening, and now we're in agreement with USDA. When we look at corn, 12.384 billion bushels, that came in 84 million bushels above trade estimates, just 1 million bushel below what we estimated here, and that, again, reflecting that we're not feeding as much as what USDA anticipated. USDA making an adjustment, lowering feeding by 50 million, not going the full amount, and also increasing ethanol demand by 25 million. And I think we'll see that ethanol number increases a little bit more as well, with corn feeding probably slipping a little bit more in the months to come. Soybeans at 2.895 billion bushels. That came in certainly lower than what I anticipated because of the smaller crop. Remember, it was 75 million bushels below expectations. but also due to USDA's numbers in the feed and residual level, excuse me, not feed for soybeans, but the residual number. That's a number that's very hard to predict from USDA and tends to be all over the place, particularly in the first quarter with large negative numbers for residual usage. But $2.895 billion, once again, reflecting the smaller crop than what the trade overall had anticipated. As we look at this year's corn yields on the map from USDA versus where we were a year ago, we see that basically we saw corn yields go up across the Midwest in the core production states. And they did come down a little bit for Illinois, down to 197 million bushels. Excuse me, and get some, I'm trying to keep my voice here today. Iowa, 203 million bushels, so very respectable and impressive crops all overall, but dropping a little bit from where we were just 2 months ago when they last made the adjustments. Soybean yields going up versus a year ago level almost everywhere, down a little bit in Arkansas and Tennessee and in the southeast, but look at Iowa, up 4 bushels from a year ago levels, Illinois up 3 bushels, Nebraska up 3, North Dakota up 9 bushels per acre, although North Dakota not a big soybean producing state. It is increasing, and we'll probably see that influence increase once again this year as well. Now, I mentioned the wheat stocks, larger than expected, and we saw those adjustments. Hard red winter wheat has been at a 7.5-month supply, getting closer to an 8-month supply surplus right now. That's why the trade hasn't been overly concerned until now or prior to now about freeze damage threats that we face. But soft red winter really facing a lot of competition and making it tough to move into the feed channels as well as the export channels. Both feed usage and exports continue to really disappoint for soft red winter. A big adjustment there now, looking at almost a 9-month supply of soft red winter. So even though acreage came down this year, that will certainly help for the 2017 crop. Still some big supplies, some big old crop supplies to chew through. As we look at projected ending stocks in the upper left-hand corner, that's what really impacts price. We see that USDA is projecting this year's wheat ending stocks at 1.186 billion bushels. And that really goes along with the chart that I just showed you. We've got a lot of old crop wheat to bear through. We can get rid of it 2 ways. One is to export, and that if we're going to do that, we need to have a lot more weakness in the dollar so we can compete on the global market, because that's a significant problem right now. Or the other thing is we can feed it. But to do either one of those, we need to have wheat prices much cheaper relative to our competition, and that competition includes corn as well. Now, corn stocks projected at 2.355 billion bushels because of the smaller production numbers. The trade was looking for something 30 million bushels above that, and now we'll look and see where that number comes. I like where they came down with the feed usage number. I think it comes down a little bit more. I do believe that they're a little bit too high on exports, but here again, that's going to hinge on South American production. In fact, both corn and soybeans at 420 million bushels, certainly more than adequate to get us to this next year's harvest, but down 60 million from last month. Now, I'll show you a graph in a little bit why soybean rallied so sharply even with that high number. But basically, the trade's looking for further adjustments to these numbers. The scope of those changes is really going to hinge on South American production. Where do we go from here? Right now, the Brazil crop is looking quite good. USDA adding 2 million metric tons to that crop. I'll show you those numbers here in a little bit. But weather can still have a big impact on both Argentina and on Brazil. Now, global stocks are in the lower right-hand corner. We see that wheat stocks continue to rise. Corn stocks are starting to ratchet down. Here again, that goes down to the smaller U.S. crop largely. Soybean stocks, pretty much as expected on a global basis. I still see them getting a little bit smaller. Corn stocks, overall, this is domestic U.S. corn stocks at a 30-year high, and just shy of a 30-year high overall. the highest since 1987-88 marketing year. When you look at the green line there showing marketing year average cash price, you see there's some more downside risk to where that cash price could end up being based on these stocks. It really comes down to a futures market and anticipating where do we go from here. That largely hinges on South America. I'll go into a little bit more detail on that in a little bit. Here's the production estimates from Argentina and Brazil. The only change in this month was that Brazilian soybean production estimate rising 2 million metric tons to 104 million metric tons. We are anticipating, the trade is also anticipating a reduction in Argentina's soybean production estimate. I'm currently at 54 million metric tons, but I will admit that it is early enough that the weather can still take things both lower and higher by several million metric tons. So that one is still particularly difficult to peg. I do believe that the soybean crop is probably at least a 102 million metric tons. We could see some come off of that yet, depending on how the crop finishes. As I talked to our office in Brazil, roughly half of the crop is still vulnerable to changes in the weather that might turn more adverse. The forecast models are suggesting that the northern half of the belt could see more dryness, increased stress as we get into the end of January and early February. That is particularly a concern for southern areas that are still later in maturity, something we need to watch. But here again, the rains have continued to exceed expectations for Brazil overall. And keep in mind that normal rainfall in many of these areas, particularly in Mato Grosso, where we have concentrated production, is 10 or more inches per month. And so if you get 50% of normal rainfall and it's evenly distributed through the month, that's adequate to give you trend yields and good production. And when we go further south to Argentina, we have seen some dryness in the far south, but the bulk of the crop belt has had good rain. I would say about 25% of the belt has had excessive rain, and that creates some problems. And that's one of the reasons we've been looking for maybe a little bit smaller production number overall, because soybean acreage is down this year, and now with some of the wetness problems preventing them from finishing planting all the double crop soybeans and creating some problems with disease and soil saturation, reducing production in some areas. So that's a number that could come down. Corn could come down a little bit more as well. Now, in Brazil, we saw last year were a dry finish to the year. Remember I said some of the models are saying the northern half of Brazil's belt could dry out as we move into February. That's where half of the Safrinha corn belt is. We saw last year a crop closer to 20 million metric tons lower than that estimate because of a poor finish to the Safrinha season. On the other hand, there are some estimates, and one private consultant in Brazil came out yesterday with an estimate of 94.4 million metric tons for the corn crop. Our estimate from our Brazilian team is currently at 91.1. So if weather provides sufficient rain for the crop to get normal yields, and normal is an average of a lot of variability in that part of Brazil, we could still see a significant increase. If we were to go back to a crop like last year, then USDA's export target for U.S. corn exports is probably 75 to 100 million bushels too low. And we'll see, but we'd see the bulk of the improved exports into next year's balance sheet. On the other hand, if we get that 94.4 million metric tons, even if we get to 91.1 million metric tons, USDA's export target is probably 75, maybe 100 million bushels too high, and then bigger implications for next year's export target. So that's going to make a big difference on our balance sheet as we go forward. Now, looking at the weather pattern in South America, U.S. Commodity Weather Group will be coming out, I think, next week with their updated forecast. This is their latest one. You can see in the upper left-hand side there the precipitation maps for January and February. Most of the dryness toward more northern and eastern areas, but you see Mato Grosso there in the center top of that upper right of the left-hand cluster is really starting to dry out as we go into February. That's too late to negatively impact soybeans in that area for the most part, but it is as we're getting the start of the safrinha corn season, so that's where it's important. Heat, not a big factor. The models may be overplaying the heat in Argentina as we look at the lower graphics there for the January. Particularly the American GFS model has a tendency to do that. As we look at March and April, which is really the core safrinha corn planting time, not planting but growing season, and then further south in Argentina as they finish up their crops down there. We do see some of that dryness here again in the safrinha corn belt, but then rains coming in April. Some of the models have more of a drier bias than that. This is something we're going to watch. Overall, when you put it all together, I think that we still have to assume normal yields here, but the confidence is very low going forward, and so we're going to have to watch it. Now, going back to those corn ending stocks, nearly half of the world's surplus corn stocks are in China. Better than a quarter of them are in the United States. So what about the other quarter of the world? Well, much of that is Argentina and Brazil. You'd have to throw the Black Sea region in there as well. But right now, the growing season's in South America. And as I said, if they have a good crop, then they compete aggressively with our exports. If they have a short crop, then we can export more and we can work down the surplus, and that narrows the margin for error for next year. A little bit more on that here in a little bit. As we look at the last 20 years, and the blue bars here on this graphic show world corn stocks in terms of days of use, days of supply. And you can see on the right-hand side that we're basically projected to have stocks of about an 80-day supply. That's up from where we were at about a 54-day supply a few years ago. If you remove the United States and China from that balance sheet, we're at a 42-day supply. That's pretty close to where we were a few years ago when we had record high prices. Not that far off of it. So South American production is huge as we go forward here now in determining whether we see prices back off because of building surpluses overseas, particularly south of the equator, or whether we see prices rally once again as in the need to ration demand. Looking over at soybeans, we continue to see this parabolic growth in soybean demand, particularly into China. I see that continuing, and basically continue to see USDA underestimating that demand growth. I expect that right-hand bar to reach up to catch that trend line here before we're done with the marketing year. Now, as we look at exports, this is a graphic looking at where USDA's tendency to understate exports in their January crop report. Particularly in recent years, they have done so. And you can see the difference here of final exports minus the January estimates. And for example, last year, exports went up 250 million bushels above what USDA projected in the January report. Much of that was because the Brazilian crop did not finish well, and we had excessive rains at harvest in Argentina. Some of the weather models looking at sea surface temperatures in the South Pacific suggest that Argentina may again finish wet. So we're going to have to watch that to see if our exports have to come up significantly excuse me, from where USDA currently has them. So what's the effect on ending stocks? That's pretty dramatic, isn't it? This graphic shows the amount that ending stocks came in below USDA's January estimate. 18 of the last 21 years, roughly 85% of the last 21 years, saw ending stocks falling below USDA's January estimate for soybean stocks. And the average of those years was about an 80 million bushel decline. So if we followed that average, it would mean ending stocks somewhere around 340 million going into the 2017-18 marketing year, leaving a much smaller margin for error for this coming summer's crops if that were to happen. So we'll take a look at that here in a little bit for 2017-18, but for now I wanted to show you this. And here again, it goes back to the previous chart where USDA simply has a tendency to underestimate soybean exports. Looking at the 2017-2018 marketing year, the graphic, the bar on the left is where I take and assume a 170 bushel trend yield this next year. I also am assuming 89.5 million acres of corn. Now, that's 4.5 million fewer than 2016. Many in the trade aren't expecting quite that drop, but as I look at our client survey that we did and other data we have out there, we've been going state by state looking at crop budgets. I actually think it could be more than that. My gut tells me it'll be more than that. I did not go more than that at this point because I know how much the American farmer loves to plant corn. And if planting conditions are good, if the moisture is good come April and May, the temperatures are good, soil temperatures are good, he just tends to get another unit or two of seed and put it into the ground. He likes to grow corn, likes to stand next to a tall field of corn. Professor told me that nearly 40 years ago, and it's held true ever since as I've watched the pattern. So I'm going to go with 89.5 million, believe it could be less than that, 170 bushel yield. And making some assumptions on demand, on some trends there, that brings us down to about 2 billion bushel carryout. That's really not bullish. That does give us a marketing year average cash price of around $3.45, not that much different than this year, just a little bit lower because we haven't had the pricing opportunities like what we had this last year, particularly with that spring rally. But here again, there's nothing bullish about that. Now, for my next scenario, I wanted to look at what is a reasonable bearish scenario that might happen. And for that, I said, well, we could get a repeat of this year's yield somewhere around 175 bushels per acre. And maybe acreage doesn't go down as much as what I think. Maybe it's at 92 million, down 2 million from this year. That results in ending stocks very close to this year at 2.4 billion bushels. Here again, nothing bullish. In fact, a little bit more bearish. I see the marketing year average cash price down to $3.15 per bushel. Now, let's look at a possible bullish scenario. In this possible bullish scenario, I'd say, okay, what if we turn kind of dry this summer and so yields pull back to 165? Remember, it's not that many years ago that we were at 123.8 for a yield. So let's pull back to 165. And let's drop those acres a little bit more, as I think that they could, down to 87. Well, at 87, if we do get a 165 yield, that drops ending stocks not only below 1 billion bushels, which is a big psychological number, it drops them down to below 900 million as well. That, I think, would fire up the money managers to buy corn and take the marketing year average cash price up to $5.75 per bushel. So there you have our anticipated on the left, a possible bearish scenario in the middle and a bullish scenario on the top, probably going to end up somewhere in between, which is what I have on the left-hand bar there. But for your planning purposes, I wanted to show you what were some reasonable boundaries on what we could see happen in 2017-18, and I'll continue to update these each month. Looking at soybeans, my anticipated scenario has, and keep in mind here, I have carry-in stocks here of about 365 million, 370 million bushels. So a little bit lower, quite a bit lower, in fact, than where USDA is, because I expect exports for the current year to still go up. I'm assuming a trend yield of 47.5 bushels per acre. Remember, this year we were just below 52 bushels per acre. And I'm assuming 89 million acres. Now, that's up from about 83.4 million this year. So that's a significant increase in acreage. I actually think that we'll probably be a little above that, but like corn, I'm being a little bit conservative. So 89 million acres of soybean, 47.5 bushel trend yield, and that gives us ending stocks of 297 million. So we're still tightening up stocks some. even with the big expansion in acreage, which is necessary, we're tightening up stocks. That's why the funds don't want to let go of owning soybeans. Now, what's my bearish scenario? Well, here I have a repeat of this year's yield of 52.1 bushels per acre, and I add about 2 million more acres to that. So that's a pretty sizable increase, about 7.5 million acres, and I believe that that's quite possible based on current price relationships. If we were to get a repeat of this year's yield, which here again was a record and was a tremendous yield, at that kind of acreage, that would take ending stocks to 704 million bushels and a marketing year average price of about $8.60 per bushel. So that would be more bearish to prices. On the other hand, if we have a little bit of stress during the year, we pull that yield down to 45 bushel per acre, and we plant fewer acres than what I'm anticipating at only about 87 million acres, that starts to draw stocks down and draw it down dramatically. And in fact, in this scenario, I had to assume that price would ration demand, reduce crush demand, and exports to some extent in order to keep stocks at a 4% stocks-to-use ratio. That means the marketing year average price of $12.15 with the board price possibly significantly above that under that scenario. So then, what about this year's weather? Well, La Nina is basically dying and expected to be dead by the end of the winter. That puts us back into a more neutral scenario with a La Nina bias. Then what do we do as we go into the summer? Some of the latest data come out has us going into a weak El Nino by the summer, neutral to weak El Nino. So if that happens, what do the analog years, do the other years with a similar type of a shift, say we can expect in U.S. weather patterns? Looking at those analog years, it would suggest that precipitation on the left would be pretty much normal to maybe a little above normal in some states of the Midwest, maybe some dryness continuing in the southeast, although much of that dryness should get relief this coming week, I should say. When we look at temperatures, it looks pretty mild for much of the country, particularly much of the crop growing regions there in the upper right. Now the graphics in the lower right show, based on some of the models that have us going into more of a weak El Nino, give a little bit more confidence to a weak El Nino, what does that do for us? Well, temperature on the left still remains mild, and so cool temperatures overall. Precipitation dries out, so it still says that we're cool, but with less rainfall. If you look at history, this type of scenario still supports normal yields. So when you look at these two possible scenarios, I think you have to brace for the possibility or the likelihood of trend or a little bit better yields as we go into the growing season ahead here in the United States. Looking at wheat here for a little bit, before we take questions, all winter wheat came at 32.383. I was really surprised that the average trade guess was at 34.1. I figured the trade would be lower than that. Last year we were at 36.1, so the trade was looking for a 2 million acre reduction, and we ended up getting, almost a 4 million acre reduction, much of that coming in hard red winter wheat. And I had one of the lower estimates, and I was still too high, about 600,000 acres too high on hard red winter wheat. Soft red winter wheat seeing some modest reductions as well as white wheat. Overall, wheat acres continue to trend down, lowest acreage that we've seen for a long, long time, certainly in my memory. If we look at overall planted area, decreasing across the bulk of the country, almost all areas of significance seeing a reduction, particularly Kansas, reducing 1.1 million fewer wheat acres, winter wheat acres this year overall. So a big reduction there in winter wheat acres. So we look at the the acreage seeded estimate coming in toward the low end of expectations, as I said. So what does this do for the balance sheet? Overall, you can see my old crop there fairly close to USDA, although I expect exports to be a little bit stronger. That carries in then to my beginning balance for the new crop year coming up, excuse me, which will start on June 1st. The bottom line here is if I assume a trend yield of 47.5 bushels per acre, 45.8 million acres overall, including spring wheat, that does drop ending stocks to 861 million bushels. That's still quite adequate. That's nothing bullish, but it is less bearish, and that's what the trade is reacting to, and certainly gives less margin for error against possible weather problems that we may face with some of the freezing that we've had and some of the drought, although here again the drought should get some good relief this weekend. Our bearish scenario says maybe USDA is a little bit too aggressive on reducing acreage, spring wheat doesn't reduce as much, and we're at 46.5. I don't expect this, but this is a possibility. A repeat of this last year's yield of 52.6. Here again, I don't expect it, but this is a bearish scenario I wanted to show. And that would leave stocks pretty much the same as this year, 1.13 billion bushels. The bullish scenario says, okay, acreage drops a little bit more, spring wheat acreage drops a little bit more than expected, plus we have a reduction in yield due to spring weather problems. And that does make a more significant impact, dropping ending stocks down to 618 million bushels. Here again, that's not bullish, but it's far less bearish, and I think would allow the price to drop. You might ask why I don't have price projections on here for the cash wheat market as I do corn and soybeans, because frankly, as we look at U.S. wheat prices, the correlation to our supply and demand fundamentals is very, very low and disappointing. It's a closer correlation to European fundamentals than it is to the U.S. There's some reasons about that we can talk about at some point. So ahead of the questions today, what are the take-home points? Well, corn stocks remain very large, but now the focus is on Brazil's safrinha crop. We're finally getting to the planting stage, expected to be a little bit wet, delaying that planting, and that could support a little bit more premium, weather premium in this market. The nearby contract's been trading primarily between 345 and 365, and those weather risks in Brazil might help hold us up in that area. A decline in U.S. corn acres in 2017 should help, is not bullish on in and of itself, but it does significantly reduce our margin for error in the coming growing season. Soybean demand remains quite robust. USDA does have a tendency to lower stocks from this point forward, and now so the focus remains on weather, South American weather, but also U.S. weather for the coming growing season. Global wheat stocks are large, probably going to stay that way. A decline of U.S. acres does help the U.S. balance sheet be a little less bearish, though, going forward. Now it is time for questions, and so we're going to open it up here for questions, and let me take a little bit of time to get this switched over to our question and answer session. You have on the lower right-hand side a place where you can type in your questions, so feel free to put your questions in there. First question I have here today is from Ron, and I expect a lot more questions to be coming because we have a big crowd today. Doesn't it seem unlikely to have 4 record-type production years consecutively relative to corn and soybeans? Has it ever happened without a down year? Now you're really going to test my memory, Ron, on whether it's happened. It is accurate to say that it is less likely to have that. My memory, though, is I'm looking back in my mind at the data and trying not to fog my vision too much by doing so and stay focused on the webinar. My memory does have that we had a period of years in the 90s when we had back-to-back record production years. Part of that was with some increase in acreage, and this year we're decreasing it, so that makes it tough. But you may be asking about record yields here. I would have to argue that we back off on yields for this coming year to at least 170. But that cool weather forecast for this coming year, and here again, confidence is low, it's a long ways out, and so there's a lot of opportunities to go different ways, but I would be more comfortable with a 170 yield looking forward than the 175 almost that we were looking at this last year. You're right. Is that enough to make us bullish? That's going to depend on South American weather. If South America gets a good crop, we need to look out for the possibility of lower corn prices and lower wheat prices. That's a real concern. Greg asked, can you talk about the spread between Minneapolis and the winter wheat markets in Chicago and Kansas City? Minneapolis wheats are inverted, 17 cents for the old crop versus the new crop today. Inverted because of demand, and this is something where I'm going to see that demand continue to hold. I think we're going to see, this is where I think the export target gets raised in the months ahead, is as a product of Minneapolis demand and to some extent demand for hard red winter as well. I think that goes up, and I think that perhaps keeps that inversion a little bit longer. Does it gain any more than on the winter wheat markets? It's pretty, and I'm not the expert on the spreads here, but we've already priced much of that in, as he's already alluded to, and I'm not sure I'm confident enough to be long on that spread too much longer in here in this market. I wouldn't make a recommendation anyway, but that would make me nervous at this point. I do think that Minneapolis certainly does see that premium continue for a while, though to some extent, and I do see some reduced spring wheat acres going forward, which should help the balance sheet for 2017-18. Jeff asked, do you think the new administration is less friendly ethanol? That could have a pronounced effect going forward. That's an excellent question. That's one that I get quite a bit. I think the way you worded it is accurate. I do think it is less friendly ethanol, and over time I think that we do need to be concerned about losing some of the structure that the government provides for the biofuels program. Ethanol has already lost many of its subsidies. We still have the mandates, the renewable fuel standard. Could we possibly lose that? I'm not going to forecast that. I think that the administration may leave that in place. But I would say this, the ethanol industry is in much better shape than the biodiesel industry right now to lose that support from the government. Much of that's due to exports. I think you're going to see an increased movement politically toward trying to get the government out of the way of the biofuel industry, particularly ethanol. That may mean more blending pumps to let the consumer make the decision. Overall, if you get ethanol to 30% blend, that's where we see our best advantages from the oxygen standpoint and overall for the fuel efficiency standpoint. The current regulations don't allow that, so there'll probably be a move to try to get that as a trade-off to let the consumer make the decision. Biodiesel, though, has some real challenges in front of it if we lose government support, and that is a concern for the soy oil market. Next question in here. Waiting for the next question. Is there somebody else who might have another question they may want to ask in here? We've been going for 43 minutes here, and I tend to try to hold these things closer to 45 minutes, but I'd still be willing to take another question or two if you have another one to give us. This report does tend to set the tone going forward, particularly when we look at the feed usage, et cetera, on the domestic usage. Janice, I hope I pronounced that right. Why does winter wheat have better correlation to EU fundamentals? I said that we talked about that sometime. I guess that time is now. Largely because the funds tend to pay more attention to the fundamentals and what's happening in Europe and in the Black Sea region and respect that a little bit more than what's happening here. We can be dry in the U.S. plains, and the funds really don't worry too much about it. That's understandable now with their big surpluses. We can be dry in the Black Sea or in Europe, and the funds tend to pay more attention to it. And why that is, I don't know. There's speculation on what reasons that is, but they just simply tend to respond more to news coming out of Europe and out of the Black Sea when making decisions about whether to buy or sell wheat. Todd asked, will you be sending out a web link via email to all participants to the replay of this webinar? We typically do post a link for that and provide a link for access. So if you've been registered, which you obviously are and you're on now, that link should be available. Yes, 84 million harvested acres of corn and trendline yields carryout goes down in 2018. 84 million harvested acres. I'd have to go back now. My memory with the day that I've had escapes me. That seems a little bit high for my bullish scenario, where I think I was at 87 million acres of planted. That did drop stocks, but that's assuming some healthy demand as well in there. But yes, as we drop the planted acres, my likely scenario was at 89.5. We typically abandon about 9%. And so that would be, let's see, about 8 million acres off of that. So that would be closer to 81 million, and under that scenario, we were constant. So 84 million, if I'm doing the math right in my head, would probably still see stocks see a little bit of an increase. By funds, do you mean real money? By funds, I'm talking about overall the hedge funds and the index funds. There's two major types of funds here that we're talking about. The index funds tend to be, as I mentioned before, the commodity funds that pretty much leave their money in a basket, a portfolio investment for the year, don't make a lot of adjustments to it. They have new money coming in kind of on a monthly basis. The hedge funds, though, are chasing the latest trend, be it change in the charts or change in the fundamentals. Tom asks, with total meat production up, how do you justify a lower feed usage number? Well, it comes down to relativity, Tom. USDA is projecting more than a 10%, well now it's closer to a 10% increase in corn feed usage, and they were, now it's with adjustment in wheat, I don't have the percentage, but it's a considerable upward adjustment wheat feeding as well. The bottom line is their projection in feed usage was greater than the increase in meat production. And so that's what I'm saying, just bring it more in line, and that's why my estimates have been a little bit lower. USDA's feed usage estimate for corn now is getting much closer on corn. I think I'm within like 20 million bushels now, so I'm getting quite a bit closer, and they're right where I've been on wheat feeding, so I think they're getting pretty close. Jeff says 9% seems high, but okay. Tyler says, is the bull case for 165 bushels per acre corn yield in U.S., assuming the current CONAB USDA estimate for South America? That's what I have to assume. That's what I have to assume at this point, normal weather. Obviously, it would be much more bullish if they come in below those estimates for production, more bearish if it comes in above those numbers for production. So good questions, great questions. Is there one more? Oh, what are your thoughts on interest rates going forward? I think you still have to have a bias. The news really hasn't changed overall, that if we are able to move forward with the promised tax and regulatory reform, that we will see growth in the economy, improvement in GDP, monetary tightening accelerating, and therefore higher interest rates. At least at this point, it would certainly appear that that is the track that we are on, and I haven't seen anything to change that. So good questions coming in. What are the time frame? Now you're going to get a little bit more difficult with me. Interest rates, the Fed has said 3 interest rates this year. The market has basically been pricing in 2. I would have to say that some of the more dovish members of the Fed have actually been talking about the possibility of 3. So I think that the first 100 days of the Trump administration will tell us a great deal about the ability of Congress to move forward the promised reforms. If those reforms get bogged down, then I think the interest rate hikes do as well. If those reforms go through Congress. I was going to use the word smoothly. Nothing goes smoothly through Congress. But if they do make it through Congress in a timely manner, then I think 3 are in order for this year, kind of evenly separated out. And if they go through more aggressively and we see response in the economy, then we could actually even be looking at 4 rate hikes. That's a big problem. Keep in mind that we just raised interest rates 25 basis points. If we have 3 more hikes of that size over the coming year, that means by December that's a full 1% rate hike. That adds $200 billion to our federal budget just to make interest payments. So with that, I think we'll wrap it up. We went 50 minutes today. You've been a great audience. It's been a great webinar thus far, and I want to thank you. We'll be back with you next month.